The Trade is brought to you by ACY Securities, Tim Cahill's official FX and CFD trading partner.
Hello and welcome to The Trade. We are coming at you from our studios here in Barangaroo. It's great to have your company. My name is Kyle Rodderwell. To talk about the trading environment right now, I'm happy to welcome Clifford Bennett from ACY Securities. Clifford, great to have you. Obviously, coming at this from a bit of a trading angle, but also obviously some of the market thematics that are affecting traders at the moment. Have this CPI data tonight. You've been, I don't want to put words in your mouth, but probably bearishly inclined when it comes to risk assets over the last 6 to 12 months. You've estimated that perhaps this inflation will be a little bit more stubborn. We get an inflation print tonight. I mean, what are your current thoughts on the sort of market backdrop and I suppose the trading environment more broadly speaking?
Yeah, I think, Kyle, you're right. I've been very bearish in 22, like aggressively bearish. And I started this year aggressively bearish as well. But I've had to temper that a little bit. We've just been in this several months now of sideways flux in the market. And liquidity has dropped and the swings have become even bigger. And I think it's been a very difficult environment for traders in the sort of 1 to 10 trading day, that sort of time range. For long-term investors, it's been I'm short or I'm long and just watching the chaos. But for shorter-term traders, it's been a very difficult environment. And overall, the market's gone sideways, but of course, there's slight changes. And we're starting to see moves in the US dollar. I think with the inflation data that we're going to get out in sort of 7-8 hours from now, I think it is, it could surprise to the upside. Yes, I am bearishly inclined. I think the market's looking for 0.2% on the monthly read. That could easily be 0.3 or 0.4%. In fact, I'm going to sort of throw my hat in the ring at 0.4%, which would really spook the market. And that's because I see the impact of gasoline prices or higher oil prices and gasoline prices hitting this data sooner than most economists do. If it doesn't hit this month, it will hit next month. So even if we got a 0.2% on the monthly read for CPI in the US tonight, we're probably going to see a 0.4 the following month. So it would be a short-lived relief. Of course, the annual rate's going to drop down significantly, but again, that could be a little bit higher than people would like to see. So I think if there's and the market's been bid into this data really, but tiring. It's bid, but it's tiring. So I think the market is vulnerable to a surprise higher inflation number than they would like to see.
Well, let's frame it in terms of the US dollar because you've got a bit of a view here. We'll get a chart up just in terms of just the long-term trend of the greenback. And I mean, it has come off its highs in particular. Do you have a directional bias at the moment when it comes to the US dollar? Because obviously some of these themes you've just mentioned, Fed policy as well, is really going to feed into the outlook for the greenback.
Yes, I mean, a currency usually reflects its economy. But with the United States dollar, it's a little bit different because it is a little bit of a barometer of global risk. And you do see massive, when there's heightened uncertainty, global uncertainty, you see US corporations, which are among the biggest in the world, immediately bring funds home. And that bringing of funds home, as well as safe haven buying, can really drive the US dollar up rather suddenly. Overall, though, in a long-term historical sense, I'm seeing that the US dollar could be really finished. Those highs we've seen in the last 12 months may have been that for the US dollar for perhaps 3 to 4 years. We are all aware that more and more transactions are being done in yuan or other currencies, or the BRICS movement away from the US dollar. All of these things are long-term gradual processes. I mean, I did speak about that at APEC and Vladivostok in 2012, that we'd eventually have 3 equal reserve currencies, the renminbi, the US dollar and the euro, and I think we're still headed in that direction. Why I worry about the US dollar at the moment is because every aspect of the United States is being sold at the moment. US property prices are now falling, US equities have already fallen and still look uncertain, and the US bond market's come off quite a lot as well. And so I think the big surprise that regardless of the inflation number could be further selling of the US bond market. So all of those will make people wonder why they are long US dollars, because the economy is slowing, excuse me, the economy is slowing, property's falling, stocks are falling, bonds are falling. Therefore, the only reason people are long the US dollar is that historical banking kind of safe haven strategy, and that the Federal Reserve is raising interest rates. But is a high yield currency worth all those other risks? Because wherever you put your money in the country at the moment, it looks a little bit uncertain as to how safe those funds will be. And I think the banking crisis is simmering in the background. And if bond yields were to go up again, if bonds were to be sold off again, as I think will happen, then you could see yet again another wave of stressed banks.
Wouldn't mind just getting a chart up just on the MOVE index, which is a little bit further through here. The MOVE index, a little bit further on, There we go. Just wanted to talk about what you mentioned just in terms of volatility in US government debt effectively, and this goes back to around 2008 where we haven't actually seen this level of volatility in treasuries since the global financial crisis, which was marked by just financial dysfunction. You spoke about the banking issues just there. I mean, can you just sort of tie that in with what we're seeing in terms of, I guess, some of the concerns in the bond market? Because if we get I would imagine, correct me if I'm wrong if you have a different opinion, if we continue to see bond market volatility at these levels, other asset classes I'm sure would have to follow.
Oh, I think it could be a little bit widespread, yes. I don't think we're going to see quite the dislocation of the GFC, but we've got to remember that in the background, I mean, financial markets are supposed to reflect the underlying reality of the economy that supports them. And in the US at the moment, consumer confidence is at GFC levels and has been at GFC levels for quite some time. And we're seeing, similar sorts of patterns in Europe as well, although for different reasons perhaps. But certainly the US consumer is in a very scared spot at the moment. And with the recent banking crisis, credit is being tightened. And we saw the IMF, mind you, the IMF has one of the world's worst forecasting track records, but the IMF has highlighted that the banking crisis will slow the global economy. And the US could be again the epicenter of that, because the GFC was exported to Europe as a sovereign debt crisis. But the GFC definitely originated in the United States. And with consumers as frightened now as they were in the midst of the GFC, I think that underlies the, if you like, fragility of some of these financial assets there, particularly bonds.
So underpinning all this will be, I suppose, whether inflation proves to be a little bit more sticky and persistent, and whether the Fed has to keep rates high for longer, because wouldn't mind just getting up the next chart when it comes to Fed expectations. This is just what the May meeting looks like. It's, sort of a 60% chance or so that it'll go 25, but after that it's, market pricing is suggesting a pause and then eventually cuts. Would you stand against that view at the moment? It's just that's not what's going to happen, because I would imagine if that is the case, again, that's another source of potential volatility.
No, I'm always a fan of standing in front of the freight train called the market. I do think that the market could finally get it right, but the market pricing of the outlook for the Fed funds rate has been wrong for the last 18 months. All along, people have been forecasting a fantasiful pivot, the Fed cutting rates. Supposedly, the Fed should be cutting rates by now, according to previous pricing. I think the market's underestimating how sticky inflation could be. So yes, in a way, it all comes back to inflation. If global oil prices continue to move higher, and it looks like they will, to around $90, $95, it won't be back to the levels it was the previous, start of war crisis levels. But the problem now is there's not much margin in the pricing of goods and services across the United States left. In other words, the pricing is already very tight. So any input now, even if it's less than the original crisis, has an immediate and profound impact on the pricing of all goods and services if it's oil. If it's the supply of energy, it's going to have a widespread impact. So the CPI could actually, and we've already seen some re-acceleration in the CPI index on a monthly basis. We saw that for a couple of months. And I think that is the risk, if not at this release tonight, certainly at the following 1, 2 or 3 months. If global oil prices go up, then inflation in the US is going to go up, and the Fed is going to hike another 75, 150 points. So that is something the market is not at all pricing, which means that's where perhaps the trading opportunity is.
Well, much will be revealed tonight, of course. Clifford, thank you so much for giving us a little bit of a preview there and framing it for us. Clifford Bennett from ACY Securities. Okay, well that does do it for this edition of The Trade. Be sure to tune in tomorrow. We'll be back with more trading action. Thanks for watching.
The Trade is brought to you by ACY Securities, Tim Cahill's official FX and CFD trading partner.